When Silicon Valley Bank went under in March of 2023, you probably remember the story. A sudden, totally unpredictable shock. A pretty good bank, just caught completely off guard by the Federal Reserve jacking up interest rates. But here's the thing, that's not the real story. This wasn't an accident. It wasn't a bolt from the blue. This was a slow-motion failure, a collapse that you could see coming for months, even years before it happened. So today, we're going to conduct a full forensic autopsy of SVB. We're going to uncover the nearly 30 distinct red flags that everyone, investors, regulators, and yeah, even its own super savvy depositors, somehow missed.
So, what was the official line? Well, according to SVB's now former CEO, Greg Becker, the blame landed squarely on the Federal Reserve. In his testimony to Congress, the argument was pretty simple. The Fed told us rates would stay low, and we believed them. He claimed the bank was just following the official guidance when it loaded up on all those investment securities. So when the Fed did a sudden U-turn, well, SVB got caught in the crossfire. Just wrong place, wrong time. It's a convenient narrative, for sure.
Not even close. Blaming the Fed just papers over a much, much messier reality. It completely ignores years of really questionable decisions, a business model that was fundamentally flawed, and a shocking lack of oversight that made SVB uniquely vulnerable. The rate hikes weren't the cause of the fire. They were just the match that lit a pile of kindling that had been stacked up for years. Kindling made of bad bets, fragile funding, and a culture of just unrestrained growth.
All right, so let's just quickly revisit those final 48 hours. For decades, Silicon Valley Bank was the bank for the tech industry. Its name was synonymous with innovation, with venture capital. So its failure wasn't just another bank closure, it was an earthquake that sent shockwaves through the entire startup world, threatening to freeze the very lifeblood of America's most dynamic sector. And when the end came, man, it was fast. It all started on a Wednesday, March 8th, with a bombshell announcement. The bank had sold a bunch of bonds at a huge loss and, oops, now it needed to raise more cash. That one little piece of news lit the fuse. By Thursday, it was pure panic. You had VCs blasting out emails to all their companies, "Get your money out, now." And this triggered a full-blown digital age bank run. Depositors tried to pull out an insane $42 billion in a single day. By Friday morning, it was over. Regulators stepped in, seized the bank. In just 48 hours, a $200 billion institution, poof, gone. So how on earth did this actually happen? Well, that's where our autopsy begins. We're going to act like financial detectives here, piecing together all the evidence that was publicly available long before March 2023. This wasn't a sudden heart attack. This was a chronic illness with dozens and dozens of symptoms that were consistently, and you could say tragically, ignored. Looking back, the evidence of SVB's decay really falls into four clear categories. First, these disastrous, high-stakes bets they made on their balance sheet. Second, a funding model so fragile it was basically a house of cards in a hurricane. Third, and this is an inconvenient truth hidden in their financial statements, their core business, their actual profit engine, was sputtering and dying. And finally, you have the critical misjudgments and just the lack of experience at the very, very top. This wasn't one single problem. This was a total systemic failure.
Okay, let's dive in. We're going to break our investigation into three parts. First, we'll look at how the bank's bad investments and its super unstable source of cash were really two sides of the same deadly coin. Then, we'll dig into the undeniable signs of decay in its day-to-day business. And finally, we'll look at the leadership failures that basically allowed this whole catastrophe to unfold.
Our first stop in this autopsy is the bank's balance sheet. This is where the story of SVB's massive gamble really begins. A gamble funded by some of the most jumpy, flight-prone money in the entire financial system. It's just a toxic combination that created the absolute perfect conditions for a bank run. Now, to really get SVB's big bet, you have to understand this one crucial accounting rule. When a bank buys a bond, it can label it as held to maturity. By doing this, the bank is basically saying, we have no intention of selling this thing, so it doesn't have to report the daily price swings of that bond. This is great for hiding paper losses when interest rates go up. Think of it like this. You lock your money in a 10-year savings bond. As long as you don't touch it, you're fine, right? But if you suddenly need that cash and have to crack it open early, you could face a huge penalty. That's the hidden risk SVB was building up, but on a colossal scale. During the pandemic, the tech sector was absolutely on fire, and all that government stimulus money flooded the system with cash. For SVB, the go-to bank for startups, this wasn't just a wave, it was a tsunami. The bank's assets grew by an incredible 271% in just 3 years. They were literally drowning in deposits, a problem most banks would kill for, but one that would turn out to be fatal for SVB. And here it is, the fateful decision. Drowning in cash with not enough startups to lend to, SVB had to put that money somewhere. They chose to pile over $100 billion into long-term, fixed-rate bonds, mostly mortgage-backed securities that wouldn't mature for 10 years or more. And by labeling a huge chunk of these as held to maturity, they were making this massive, unhedged bet that the Fed was right, that inflation was transitory, and that interest rates would stay near zero for a decade or more. But where did all this cash come from? Well, that's the other half of this really dangerous equation. Unlike your typical neighborhood bank filled with small, FDIC-insured checking accounts, SVB's deposit base was incredibly concentrated. About 90% of its deposits were way above the FDIC's $250,000 insurance limit. These weren't mom-and-pop savers. These were sophisticated VCs and big tech companies with massive payroll accounts. And you better believe, they are the first people to run for the exit at the slightest sign of trouble, making SVB's funding source a ticking time bomb.
So we've got a ticking time bomb on the balance sheet, fueled by super unstable deposits. But you know what? The problems ran even deeper. The bank's core business, its actual profit engine, was rotting from the inside out, long before anyone was even whispering about a bank run. And the signs? They were all there, hiding in plain sight in their quarterly reports.
Let's talk about something called net interest margin, or NIM. It's really the most basic measure of a bank's health. It's just the difference between the interest it earns on loans and what it has to pay out for deposits. Think of it like a retail store's markup. A healthy bank has a nice, stable, profitable margin. But SVB? A total outlier, and not in a good way. For a decade, its margin was way below its peers, and it was falling. They were basically buying their growth by offering cheaper deals than everyone else. That's not a sustainable business, that's a race to the bottom. And if NIM was a warning sign, then return on equity was a blaring 5-alarm fire bell. ROE tells you how well a company is making profits for its shareholders. For years, SVB looked like an absolute superstar on this metric, a real Wall Street darling. But then look what happened in late 2021. Its ROE absolutely cratered. It fell from the high 20s all the way down to single digits, underperforming its peers for the first time in nearly a decade. This wasn't some future problem tied to interest rates. This was a current crisis. The bank's profit engine had already seized up. And hey, if you want to know what the people on the inside really thought about the company's future, this number says it all. Between 2013 and 2022, for every single share of company stock that was bought by an SVB insider, over 100 shares were sold. Publicly, they were projecting confidence. Privately, well, their actions told a very, very different story.
So who was steering this ship into the iceberg? All these problems, the bad bets, the fragile funding, the collapsing profitability, they didn't just happen by accident. No, they were the direct result of decisions that were made, and maybe more importantly, not made, by the bank's senior management and its board of directors. The ultimate failure here was a failure of leadership.
I mean, this table is just stunning. Take a look at the independent, non-executive directors at SVB. These are the people whose entire job it is to oversee risk and challenge the CEO. So how many of them had high-level executive experience actually running a bank? 0. How many had experience as a bank regulator? Someone who understands the complex rules of the road? 0. The very people tasked with oversight at this rapidly growing, increasingly complex bank just lacked the deep, first-hand experience to do the job.
And hey, you don't have to take my word for it. This is a direct quote from the Federal Reserve's own brutal postmortem report. And the most damning part? This wasn't just them looking back with 2020 hindsight. Fed supervisors had told the bank this exact same thing, that the board's oversight was inadequate, almost a full year before it collapsed. The warnings were crystal clear, and they were ignored.
At its core, the problem was a culture that just prioritized growth above everything else. Look, when a bank more than triples in size in just a few years, it's like strapping a rocket engine to a station wagon. If you don't upgrade the brakes, the steering, and the whole chassis, your risk management systems, the whole thing is going to fly apart at the first sharp turn. And that's exactly what happened. Both the FDIC and the Fed concluded that SVB's management was obsessed with the accelerator and completely ignored the brakes.
Okay, so let's step back from the microscope for a second and put all the pieces of our autopsy together. When you lay out all the evidence, the collapse of Silicon Valley Bank stops looking like a surprise and starts to look, well, like an inevitability. This was a bank so fundamentally flawed that it was just waiting for any kind of shock to push it right over the edge.
So here it is, the 4-step recipe for the second largest bank failure in U.S. history. First, you take a massive gamble on interest rates. Second, you fund that gamble with the least stable money you can possibly find. Third, you completely ignore the clear signs that your underlying business is already failing. And finally, you make sure the people who are supposed to be in charge of oversight aren't actually equipped to see the danger. Any one of these would be a major red flag. All of them together, they created a perfect storm.
And that brings us to the final lingering question. And it's a tough one. The depositors at SVB weren't average citizens. They were the financial heads of tech companies, they were venture capital funds, some of the most sophisticated financial players on the planet. All the red flags we've just talked about were sitting there in plain sight, in public filings. So here's the question. When sophisticated players ignore such obvious risks, should they be made whole when the whole house of cards collapses? It's a question that cuts right to the heart of risk, responsibility, and moral hazard in our financial system, and it's one we'll be grappling with for years to come.